Hi, and welcome to today's episode where we have invited Ruby Chauhan from 360globaltax.ca. Her firm specializes in cross-border taxation and international tax and relocation matters, especially from a Canadian tax perspective. And today we have invited her to explore what are the implications if a business owner is moving out of Canada and ideally in this situation, Dubai, and how can we structure the tax situation in a way that they become a non-Canadian tax resident and they don't have to pay tax back in the home country. So, welcome to the show, Ruby. Thank you for joining us. And if you can give us a brief introduction about yourself and about your company, that would be helpful.
Thank you very much for having me today. I'm really looking forward to this. It's going to be very informative for Canadians and non-residents living across the world, especially in the UAE. My name is Ruby Chauhan. I'm the co-founder and vice president of 360 Global Tax Professional Corporation. We're a boutique tax firm based out of Ontario, Canada, specializing in helping Canadian expats and non-residents living across the globe from Denmark to Australia to Dubai, Doha, Saudi, etc., and beyond from all over Canada. So we also help individuals from Quebec who deal with Revenue Quebec and Canada Revenue Agency. And we're also part of the Canadian Business Council of Dubai and North Emirates as well. So we help a lot of individuals in the GCC. And we also annually, at the start of the year and the end of the year, go over to Dubai and host events and tax master classes. So we welcome everyone over there to come join us, learn whether you're our client or not. It'll be very informative. And again, thank you so much for having me today.
Great. Thanks for that amazing introduction, Ruby, that clarifies the scope quite a lot. So let's just jump right into today's topic. And I want to start with asking you, what are the reasons at the moment that you find that Canadians are moving abroad? Can you touch upon that quickly?
Absolutely. This is a wonderful question because we're coming to a time that a lot of individuals are moving across the world, whether they're young and, looking for exciting opportunities, whether they're looking to retire abroad, or a few of the main reasons I would say is taxes. Our taxes in Canada are very, very high. Actually, on average, the Canadian family paid about 45% on taxes. We have graduated tax rates. If you make over 250K, depending on the province that you live in, you can actually end up paying close to 50% or more in taxes. Otherwise, I would say cost of living is increasing here. Our real estate industries are becoming very expensive. As well, our cold climates. I think a lot of people want to move abroad because it's cold about 6 months of the year. So that's a quick recap on why people are moving.
So, yeah, my next question is obviously my clients who are moving out of Canada and moving to Dubai. The most important goal is to become a Canadian non-tax resident. So they're no longer taxed in Canada by the CRA. So my question to you would be, what are the requirements and what is the process of becoming a Canadian non-tax resident?
This is a very important question that we deal with every single day. And usually the first step when individuals are planning their move abroad, they come to us actually to figure out their tax residency status. When do they actually become a non-resident for tax purposes? What are the tax implications to them for their real estate, investments, potential employment income that they might earn after they leave, or if they are potentially starting a totally new business abroad, such as in Dubai. So the Income Tax Act of Canada, which is the book that we abide by, which sets out the tax implications and requirements for Canadian tax residency or non-residency, doesn't clearly define who is considered a tax resident or non-resident of Canada. So we look at a set of ties, which we consider either primary ties or secondary ties. Now, primary ties to Canada consist of three main ties. One, where is your spouse or partner? So, for example, are they moving with you? Will they remain in Canada? Two, your dependents, such as children. Will you be leaving children here in Canada or taking your family with you? And three, Canadian real estate. Is it available for your use? Will it be rented out to a third party? Now, the second set of ties that we look at are, it could be anything, such as your provincial health care. Have you canceled your provincial health care, your driver's license, memberships to golf clubs, etc.? And actually, previously, in various cases that were set out in the courts of Canada, the CRA has actually looked at memberships and gone to, do they have a golf membership, etc., to determine how many ties someone continued having while they lived abroad. So we look at your entire situation to determine when did you actually become a non-resident or not? Because, for example, perhaps you moved abroad 2 or 3 months earlier than your wife or husband, and they may still be considered a tax resident. Now we need to figure out, when did you both actually become tax residents? Is your worldwide income still taxable in Canada until your wife left, and those kind of things? And let's say we determine when you become a non-resident. The next step is reporting your departure to the CRA, Canada Revenue Agency, our taxing authority.
Okay, so my next question is that what kind of processes this needs to be done to become a non-Canadian tax resident? Are there any kind of special filings or is there any process to follow? And also a supplementary question to that would be, once they become a non-tax resident of Canada, do they still continue to file any tax returns? How does that look like?
Perfect question. So, when you become a non resident, there can actually be various filing deadlines and requirements. Some can actually exist right when you become a non resident, and others may need to be filed by April 30th of the following year, which is our tax deadline in Canada, April 30th of each year. So, when you become a non resident, we have to report your departure and emigration from Canada. We submit something called a part year Canadian tax return. Now, this tax return is different than your regular tax return when you're a resident of Canada. It has different disclosures about your emigration date, about investments, because some investments could be taxable on the fair market value when you leave Canada. It also has different forms and disclosures related to property ownership and Canadian property ownership. And if you fail to file these forms and disclosures by April 30th, there are certain penalties that exist that could be up to $2,500 per the taxpayer. So it's really important that your tax returns filed in a timely fashion. Now, my second answer to that, and what I said earlier, is that you might have to file something right away. Now, when I talk about that, I'm referring to if you begin earning rental income as a non-resident, then there are certain tax filing and withholding requirements that start right away, and which we'll get into a little bit later. Now, another answer I have to this is, let's say you've become a non-resident. We've filed your non-resident Canadian tax return, your Canadian tax return to report your departure. Now, assuming that you no longer are earning any Canadian income, you no longer have to file Canadian tax returns. However, often when individuals move abroad from Canada, there are certain types of income that you may continue to earn, such as investment income, pension income, or rental income. Now, when we talk about investment income, which could be dividend income, interest income, etc., it's really important that you advise your financial institutions you're a non-resident so that they can withhold the correct amount of tax. Because in Canada, when you become a non-resident, there's a division called Part 13 and non-resident tax, and they look after any sorts of income non-residents earn, and they want to make sure tax is withheld upfront. So when it comes to, let's say, investment income, if they've withheld the correct amount upfront, they would issue you a non-resident tax slip. Any time individuals who are non-residents earn income, they normally receive NR4 non-resident tax slips. If the correct amount of income was withheld on that NR4 slip, then you're all good. You don't have to file a tax return. But let's imagine that you weren't issued an NR4 slip and you received a regular tax slip, which we call T slips, such as T5s, T4s, etc., or the correct amount of tax wasn't withheld. That's a situation where you might have to file a non-resident tax return now. Now, in another situation, let's say you've retired and you moved abroad. If you continue to receive CPP, Canadian Pension, or Old Age Security, which you are entitled to regardless of where you live in the world, you may have a tax filing requirement. If you receive old age security, you must file an old age security return every single year. Or if you receive CPP and you weren't issued an NR4 slip, you may have to file a tax return for that. Same with rental income. There's various rental tax filing requirements as well. So it really depends on your situation. You may not ever have to file a Canadian tax return again, which would be wonderful, or you may continue to have some tax filing requirements.
Sure. Thanks you for the explanation. My next question would be on the timelines. So, assuming if someone decides to become a non-tax resident starting, let's say, January 1st, what sort of timelines would be involved? What sort of events should happen? And when can they expect to become a truly non-tax Canadian resident? How would
Now,
that timelines look like?
this is a good question. Let's assume in this situation, someone is actually leaving January 1st, 2024. Number one, if they begin earning rental income right away from January 1st, a lot of situations, Canadians move abroad, however, they keep their Canadian real estate. Now, if they start earning rental income, they're going to have to deal with non-resident tax withholding requirements right away. However, the actual tax filings are not due until the following year. So, your departure from January 1st, 2024 wouldn't be reported and filed until the following year, April 30th, 2025, because that's when the 2024 tax return would be due. Until such time, there's no actual tax filing requirement. And then your tax return the following year would report your departure. We'd make sure that the CRA, Canada Revenue Agency, marks you correctly as an immigrant effective that date. And also, it's really important that you correctly update the CRA about your non-resident tax status and file the correct tax returns, because you don't want to be in a situation where you're unnecessarily receiving provincial tax credits, or we have something called child care benefit, where a lot of families receive child care benefits. And if you haven't filed your tax returns or reported your departure, you may continue receiving these benefits until you are correctly updated. But the issue is, if this is done years later, you may have a large tax bill owing to the CRA. And another key component and reason why it's key that the CRA knows you're a non-resident is because unless you're marked a non-resident and they consider you a tax resident, they expect you to report your worldwide income. And the whole benefit of becoming a non-resident is so that you are tax-free from Canada on income earned outside of Canada. So it's really important that you're marked a non-resident as a non-resident, so CRA is not possibly looking after you to tax you on your worldwide income.
Okay, thank you, Ruby, for such an insightful session so far. And my next questions would be on the property side. So many investors who have their own home in Canada, when they're leaving Canada, they turn their primary home into a rental or an investment property. So can you shed some light on what happens to that, and if having that home, even if it's converted to rental income property, does that counts in the primary or the secondary ties that you have mentioned earlier in the start of the session? And how does this fits in? How can we make sure that we can still keep the rental property and become a non-tax resident, and if that is even possible, and what would be the tax implications of those rental incomes?
So I'm going to answer this question in a few parts. Most Canadians, when they leave Canada, they do not sell their Canadian real estate, and instead they convert their principal residence to a rental property. So number one, I'm going to talk about how is property actually treated during the time you leave Canada. So when you leave Canada and we file your Canadian tax return, there has to be property a disclosure about your property ownership. So the first part is we have to submit a form called T1161 list of properties by an immigrant. Now on your tax return, property ownership is reported and also the fair market value of the property. Now the great thing and a big misconception is that a lot of individuals believe that they have to pay departure tax when they leave Canada on the value that the Canadian real estate they own has increased. Now, the great thing is there's no departure tax on Canadian real estate. Tax on real estate and any potential capital gains is actually paid when you sell a property. So that's one key aspect. Now, two, when you have a rental property as a non-resident owner, there's two different divisions that come into play at the CRA for you. One is called the individuals division. That's associated with your social insurance numbers and your tax returns. Then there's a different division called Part 13 and non-resident tax. They look after any sort of income non-residents earn, such as rental income, and they have tax withholding requirements set up. The Part 13 division, when someone earns rental income as a non-resident, they give two options to withhold tax. The first option we call the default option, and most individuals don't go with this. I would say less than 5% of individuals, where you have to pay 25% of your gross rent every single month to the CRA to a designated non-resident account. Now, you can imagine when you have property taxes, mortgage payments, etc., most individuals don't want their money tied up with the government. So, when you withhold 25%, the CRA actually allows a taxpayer to open up their own non-resident account, or you can have a third party such as 360 Global Tax who's already registered as a tax withholding agent. And this process is essentially broken down into three parts. Part one, you're paying 25% every single month to a non-resident account. Imagine you're earning $2,000 Canadian every single month. That means you're paying $500 a month. In a year, CRA is holding on to $6,000, which you could have used elsewhere. So part one, taxes paid. Part two, you receive an NR4 non-resident tax slip. It'll indicate how much tax you withheld under that non-resident account. Part three, you're required to submit a specific tax return. We call it the S216 non-resident return. And on that tax return, only your Canadian rental income and Canadian rental expenses are reported. And then you're taxed on your net income after all those expenses, and you'll be in a refund position. When you withhold 25%, you will always receive a refund because you paid way more tax than is necessary. And when you withhold 25%, CRA actually gives you up to 2 years to file your tax return. Rather than that April 30th deadline that every taxpayer has, they give you up to 2 years because they're holding on to your money, likely in an interest bearing account, and they're not in a rush to refund you because they know you're going to be in a refund position. So that's option one, which is a default method, which I would say many individuals don't go with. Option two is called Form NR6. The NR6 form, it allows you to pay reduced tax withholdings, and you must have a third party, such as 360 Global Tax, who acts as your tax withholding agent. So our firm does this for close to 1,000 non-residents living across the world, where we offer the comprehensive NR6 tax services. So I'm going to explain the process again, broken down to three parts. Part one, until the NR6 form is filed, you have to pay 25% of the gross rent. So for example, our firm, we start the process around October, November for the upcoming year. So all of our clients are approved effective January 1st to pay reduced tax. So step one, we prepare your NR6 form. It's almost like an estimate tax return for the year. And once it's approved, you're allowed to pay 25% of your estimated net income for the year. So if you imagine if you're estimating a loss in rental income, more expenses than rental income, and your rental income's estimated as $0, you can end up paying $0 in tax upfront for the year compared to 25% of the gross rent, or very little after considering your rental expenses. And the rental expenses, by the way, that we consider as deductible expenses are mortgage interest, which is usually one of the largest expenses, property taxes, insurance, accounting fees, leasing fees, advertising fees, maintenance and repairs. So almost everything related to your rental property becomes tax deductible. So step one, NR6 form is filed. Any payment of non-resident tax is made to our non-resident account. The rest of the year, the taxpayer doesn't have to worry about any more forms or payments. We include our mailing address. We make sure that your NR6 form is approved correctly, on time, etc. Now, the following year, we prepare an NR4 slip, non-resident tax slip. It'll indicate you had an exemption to pay less tax because you had an approved NR6 form. It'll indicate our 360 global tax information, your taxpayer information, such as your social insurance number, etc. And part three, this is where it gets a little bit different. Because the CRA allowed you to pay less tax, they want to make sure if you have any tax owing that you pay it on time and you report your rental income. So they have a very strict tax filing deadline of June 30th of the following year you earned rental income. So if you fail to file your tax return by June 30th, your Canadian agent who signs off on the NR6 form, such as 360 Global Tax, we receive a penalty of 25% of the gross rent plus arrears interest. And that's because the CRA allowed you to pay less tax. You could be anywhere in the world. You didn't file a tax return. So they're going to go after the Canadian company or individual who signed off on your NR6 form and become liable for you. So we have this process set up very, very well in-house where we ensure all tax returns, tax forms, everything are filed in a timely fashion because we don't want our clients to receive any penalties. And we definitely don't want to have to chase you in Dubai or Australia or wherever to find you for any penalties.
Let's say someone has moved out of Canada, settled in Dubai, become a non-tax Canadian resident, and followed the process of reporting the rental income based on option B, let's say
Mhm.
that you have advised. Now, if they sell this property at this point, what could be the tax implications for that event?
This is a great question. So, and sometimes it's a surprise to non-residents after they've already listed their property for sale. It's really important that they consider this because it could impact timelines and monies received and items like that. So, as a non-resident disposing of Canadian property, and when we say disposing, we're talking about selling, transferring, or gifting property. There's something called a certificate of compliance application and non-resident tax return requirement. The certificate of compliance applications, they calculate 25% of the net capital gain. And in these applications, there can be various forms for principal residence exemption, for the property being a rental property, etc. Now, the certificate of compliance applications, they must be filed. And if you fail to file the applications, the penalties per non-resident tax payer or owner can be up to $2,500 each. Now, what happens is the certificate of compliance applications, they must be filed within 10 days of closing. At the same time, the real estate lawyer is required to hold in trust 25% of the gross proceeds of sale. So imagine if you're selling your property for $1 million, 25%, 250,000 is held with the lawyer. You don't have access to these funds in case you need to pay off a mortgage or you're looking to use those funds to buy another property or use it for another sort of investment. So certificate of compliance applications are filed. The lawyer is holding on to 25%. The CRA assigns a special agent in the dispositions office there. They start working on the applications. They'll request a payment of 25% of the net capital gain. Now, we share that request with the lawyer. From the money the lawyer is holding in trust, and a key thing is we don't want the lawyer to send the whole 25% of gross proceeds to CRA. We only want them to send the amount requested by the CRA. Once CRA receives their payment of 25% of the net capital gain, they'll issue the certificates of compliance. Once the certificates of compliance are issued, the lawyer can release the rest of the money he's still holding in trust back to the taxpayer. Now, two caveats about this situation. One, which I would say is the main concern for non-residents, is it takes around 6 to 8 months currently for CRA to issue certificates, which means for about 6 to 8 months, that taxpayer is not going to have access to that 25% of gross proceeds being held by the lawyer. Two, as per the Income Tax Act, if someone has rental property, it can actually be requested that 50% of gross proceeds be held by the lawyer. Now, I rarely see this happen. I would say 1 in 100 cases. And that usually happens if, let's say, a buyer of a property is concerned, the buyer's lawyer is being a little bit pushy and saying, we want the taxpayers to withhold 50% instead of 25%. Now, that's a pretty serious case for a seller. It's a lot of money they're not going to have in their pockets for about 6 months. So what we try to do is share across the applications to ease any concerns about how much the actual tax liability is going to be. And usually that works. And always, I would say 99% of the time that I've seen, every single time I've seen myself personally, tax is always less than 25% of the gross proceeds anyway. So 50% is a lot more to hold on to. So that's step one, the certificate of compliance process. Now, step two, the following year, the taxpayer is required to submit a non-resident tax return. This is a different type of tax return than rental income. On this non-resident tax return, the sale is reported and any selling related expenses are reported as well, such as realtor commission, legal fees, accounting expenses. This will lower the individual's capital gain by a lot. Now, on this tax return, only 50% of the capital gain is actually taxable. So let's imagine, I'll do a sample calculation, but let's say on the tax return, 50% of a gain is taxable and then you're refunded any overpayment of tax. So as a quick example, let's imagine you bought a property for 500,000 and we're selling it for $1 million now. And let's just imagine you never lived in it as a principal residence and it's taxable for the whole duration of ownership. Now you're selling for $1 million. So that means your lawyer is going to hold on to 250K. 750K is released back to you on the closing date. Now 500,000 is the capital gain between 500 and 1 million. So 25% of that is 125,000. So to issue the certificate, CRA is going to want a payment of 25% of the net capital gain. So from the 250K the lawyer is holding, 125K is paid to the CRA to issue certificates. Now let's imagine 6-7 months have gone down the road, the certificates are issued, the rest of the money your lawyer was holding, 125K left over, is released back to you. Now the following year, let's imagine your gain was still 500K, but you had a lot of selling expenses. Let's just imagine your selling expenses were 100K, just for easiness of the calculation. You know, we know realtor commission can be high sometimes, etc. So now the gain has lowered to 400K by 100K because of those expenses. On this tax return, only half the gain is taxable. So half of 400K is 200K, the gain. CRA is already holding on to your payment of 125,000 that you paid to issue the certificates. So they have that as a tax installment. Now this 200K capital gain, it's going to be taxed at the graduated tax rates. We have a number of tax rates, 15%, 20%, etc. Now for this example, let's do an average of, let's just say 25% based on the various tax rates. At the end of the day, on a 200 gain at a tax rate of 25%, you're paying about $50,000. Now, So your tax liability is 50,000. They're already holding on to 125,000. So when CRA processes that tax return, you're going to receive back about $75,000 in a refund. Mind you, this is an estimate only, so we have to file your actual tax return to get the exact tax rate, but that gives you a good idea. You've had a $500,000 gain, some expenses. At the end of the day, you're paying about 50K in capital gains tax. Now,
Makes
to
sense. Yeah.
yes, and to add to that, there's something called principal residence exemption. We talked earlier and we said most individuals, they've lived in their property, then they leave, and then they convert it into a rental property. So anytime someone lives in a property as their principal residence in Canada and they're a tax resident of Canada, that period of ownership is tax exempt. And the principal residence exemption has something called a +1 rule, meaning for one extra year, capital gains is deferred and not taxable. So when we sell a property, we'd also consider were there a number of years that was exempt from tax? We'd add that principal residence exemption. So they're only paying tax really on the years that it's not tax exempt.
Thank you, Ruby, for those insights on the sale of the property. And my next question would be, is there a departure tax or an exit tax in Canada? And if there is, then how does that look like? How is it calculated? When it is paid? How it is reported? What are the scenarios involved in that?
This is a great question because a lot of individuals have moved abroad and disposed of items they didn't need to, such as Canadian real estate, etc., because they were really worried about paying tax on such a large capital gain. And the good thing is, good and bad thing, yes, there's departure tax on some items. No, there's not departure tax on other items. So there is departure tax on items valued at over 25,000, which includes property such as jewelry, paintings, different sorts of collections, non-registered investments. And what happens is when someone becomes a non-resident, effective their date of departure, their emigration date, we consider it a deemed disposition. Deemed disposition means that the taxpayer has sold and bought back the property at fair market value. So even though it's an unrealized capital gain, they are going to have to pay departure tax on those items. And items that there isn't departure tax, which is a really good thing, is that there's no departure tax on Canadian real estate. Now, if there was, you can imagine paying tax on hundreds of thousands of dollars of capital gain. However, tax on property is only paid when you actually sell a property. And like I said earlier, tax is subject on property if, for example, it wasn't their principal residence, if they don't have a principal residence exemption, etc. Now, departure tax is calculated alongside the preparation of your part year Canadian tax return. Any departure tax would have to be paid by April 30th of the following year that you left Canada. Now, the good thing is that there is ways to defer paying departure tax on certain property in case that departure tax is very high. There's different forms that can be filed to help you out so that it's not all payable at the time that you file your tax return.
Sure. Thank you. And thank you for clarifying on that. A major question that comes quite often when I'm helping Canadian clients move to Dubai is the part of the process where someone is moving from Canada to Dubai is that we help them set up a UAE free zone company that further optimizes their taxation while they're in Dubai. But the question comes, does the income in this free zone company by any chance gets taxed in by the CRA, or do they have to report that back to the home country in Canada? How does that look like?
This is so important because, like we said earlier, the main reason a lot of individuals are moving abroad is to be tax free from Canada because our Canadian tax rates are very high. Now, if you've correctly reported your departure and now you are actually a non resident of Canada, you are no longer required to report your worldwide income. Meaning, if you don't need to tell the CRA about your worldwide income, about your corporation, you're not required to. In Canada, we have a saying that only Canadian source income is taxable in Canada if you're a non-resident, meaning if you live overseas, if you're earning any money from Canada, then yes, there's going to be tax requirements to your Canadian income. But as a non-resident, you are not liable to pay tax on your UAE corporation. Now, the concern happens if that individual decides to move back to Canada, become a tax resident again. As a tax resident of Canada, you are required to report your worldwide income, including corporate income. So, as a non resident, that is not a concern, and that is the main reason people are moving abroad.
Sure. Thank you. And my next question would be, can you advise on what are some of the common misconceptions that you see for Canadians who try to move abroad and become a non-tax resident?
It's a wonderful question. One, I would say, do people have to sell their Canadian real estate when they leave? Big misconception. You do not. You can convert it to rental property as long as the home is not available to your use and it doesn't, look like you have a home that you're living in, visiting multiple times throughout the year, etc. Another big misconception is closing your Canadian bank accounts or investment accounts. Now, we recommend, of course, not having 4 or 5 Canadian bank accounts or 4 or 5 credit cards going on where it doesn't appear that you're ordinarily living your life through your Canadian accounts. Having one or two is not a make or break to your tax residency status, especially if you still are a Canadian rental property owner or you receive some sort of investment income or retirement income into your Canadian accounts. That's a big misconception. A huge misconception is that tax residency is tied to immigration status. So a lot of the time when we speak to individuals, it seems people are a little scared or worried that if they are a non-resident for tax purposes, they're no longer a Canadian citizen or permanent resident. However, citizenship is not tied to Canadian tax residency because you can imagine maybe you're a non-resident for tax purposes for 10 years, but you decide to move back to Canada in future. You're still a Canadian citizen. Or otherwise, another misconception actually is that you can no longer earn any employment income from Canada. You can actually be a non-resident of Canada and still be employed for a Canadian company or receiving some sort of contract income. So I would say those are the main misconceptions.
Thank you, Ruby, for such an in-depth session. I hope it would be quite helpful for the viewers who are planning to move out of Canada or have already made the move and looking for next steps. So I want to conclude this interview for now, but I want to ask you, like, if someone wants to reach out to your company for your services and the services of your company, like, how can they reach out to you?
Shiraz, firstly, thank you very much for having me today. I really enjoyed talking about Canadian tax. It's my passion. And also, to reach out to me, feel free to check out our website, 360globaltax.ca. Email me, ruby.chauhan, CHOUHAN, at 360globaltax.ca. Keep a lookout for our events happening in the GCC in Dubai, Doha, etc. this winter and early next year on Canadian tax. We welcome you to join. It's a really good, informative session. Whether you become our client or not, it will be beneficial to you. And again, thank you so much. Please feel free to reach out at any point. We specialize in helping Canadians living and working across the world.
Thank you, Ruby. It was a pleasure having you on the show today, and I look forward to continuously working with you in the future as well.
Thank you.
Thank you. Bye bye.